All right, so I've warned you about Japan many, many, many times, and I think that still a lot of people aren't getting it. I see in my comments people like, I did a video yesterday, investing versus Social Security, and basically take Social Security early and invest it relative to waiting to take Social Security later, and in the interim, pulling your money from your portfolio. Personally, for me, it's not even it's not a debate. Frankly, I'm going to take Social Security as late as I possibly can and take my money from my portfolio in the interim. Now, it's all relative. There's no right or wrong answer. The question is, in hindsight, who is right or wrong? And hindsight is going to show you that either you are right or you are wrong. But I'm just telling you, if you are investing based on the premise that you can outperform XYZ, in this case, Social Security, forget the taxes, forget all that. You're investing because you think the market is going to do this relative to what I can get on Social Security. Okay, you might be right. But a lot of these people are investing like that because they use historical data. And this is what drives me crazy about Dave Ramsey. Well, the market has given us a 10 to 12% rate of return going back to the basically modern era. And I cannot fathom that people would invest with that basics as if I'm going to do a plan contingent on historical rates of return in America. I don't get that. Well, you're too bearish. You don't have enough optimism in America. No, I have plenty of optimism in American people. I don't have plenty of optimism in the markets, though. And the reason I don't is because the markets are based on earnings growth. Earnings growth is that simple. And then dividend yields. So let's look at it. I just want to throw some freaking cold water on it here, my friends. We're going to look at Japan. And so I went here. I said I typed in Japan mutual funds into DuckDuckGo, and these are where I came up with. T. Rowe Price goes back to 1991, 2000, I think. This goes back to 1993. This goes back, I can't remember. This one went back to 1998. I want to go back to 1990. So far, T. Rowe Price goes back to 1991. Then this guy went back, Fidelity Small Cap, to 1985. This guy right here, I was surprised by. Went back to this. I'm sorry, Fidelity Small Cap went back to 1993, if memory serves. This guy right here, DFA, went back to 1985. I was surprised by that. That was interesting to me. But this is what I'm looking for: the Commonwealth Japan Fund. I like this a lot because what we'll see, it goes back to 1989, which is perfect. And this is the perfect fund to analyze your Japan. What happened if you were in Japan? Long-term capital appreciation and current income. Under normal market, it invests at least 80% of the net assets of securities of the Japan issuers that are tied, or stuff that's tied economically to Japan. May also enter in derivative transactions. All right. But what I like about it, because they're basically saying at the end of the day, they're going to be investing in mostly large cap Japanese related stocks that have something to do with Japan, either in Japan, ADRs, or a heavily Japan focus. So that's good to me. So I'm going to portfolio. Let's just look here. So we're going to go back to, it doesn't have that much in assets. Isn't that interesting? Like $7 million. And the expenses are probably going to be pretty high right there, 1.75. All right, so that works, but this will work because I'm just telling you, if we go back to history, I guarantee their NAV, net asset value, has gone down because they haven't made any money for people for a long time. And it's not just because these guys are bad asset managers, it's because of the way the Nikkei was in Japan stocks. All right, so let's keep looking here. Japan stock is just what we want. It's what we want. Now look at this. Look at all this red. This tracks the Nikkei. That's exactly what the Nikkei has done. And if you look, just look at this. Red. Now, it's not quite as bad. The Nikkei is not quite as bad because the Nikkei from basically 2012 has actually had some pretty good numbers. This quite isn't showing it as well because the fees are pretty high. But then we're going to use this, and we're also going to look at the Fidelity or the DFA right here, which is DFJSX, and we're going to compare the two. We're not. Hang tight for just a second. We're going to go to performance on This is small companies, and I didn't want small companies so much. Look, I'm a big fan of DFA. Expense ratios are low, which I like. They have 475 million, which is good. So they have a more sustainable than the Commonwealth Japan Fund. But the problem is it's mostly small companies. I don't like that. I was trying to go mostly Nikkei. They're trying to get long-term capital appreciation, invest in substantial office assets and the corresponding master fund the Japanese small company. All right, so it's the small companies don't quite track the Nikkei as much as I'm hoping, but it does go back, to 1985. So I like that. But you still see, and what you'll see, see, it has a better track record over the last 10 years than the Commonwealth Fund. So, but I still want to use the Commonwealth Fund because I think it's more of a large company, and that's what I'm trying to show you guys. So if we go to Portfolio Visualizer, I'm telling you, man, we're gonna start with $100,000. We're gonna go into the Commonwealth Fund. We're gonna put $100,000 in, and we're gonna see how this shook out. And what you see is $100,000 in 1990 is only worth $74,000 31 years later. I don't get how people can't recognize that this could happen to you for sure. Now you could say the fees are so high. That's why we're going to look at the DFA one, and then we'll even look at the T. Rowe Price. That's without pulling any money. All right, so if you start pulling money out, or say 5% a year, because remember in 1990 everyone was bullish on Japan. No one's like, oh, Japan's going to go bankrupt. It's not going to have any growth. No one thought that. Start pulling money at 5% a year, $5,000 a year adjusted for inflation, and lo and behold, we were out of money in 2004. So it lasted all 13 years. That's not good. Now, the converse of that, though, if we start adding money to this, all right, we're going to contribute $5,000 a year adjusted for inflation. I'll watch what we do because we're buying shares on the cheap. Ah, look at that. So you would have done much better in the S&P 500, obviously, but you're basically buying shares on the cheap for that. The way when the market comes back, you'll have more shares to show for it at a higher value. It's still not that great, but at the end of the day, this is the point about investing versus divesting, if that makes sense. Accumulation versus decumulation. When you're investing in stuff, it's hard to go wrong when you're just plugging money in. As long as you have enough cash on the side to pay the bills, is when you're pulling money out. All right, so I hope that makes sense. So let's go now to, we're going to look at the DFA one. That's DFJSX, DFJXX, DFJSX, DFJSX. DFA I like. I don't think, well, I don't want to get to the thing on DFA right now. So what we're going to do is we're going to pull, we're not going to contribute anything. All right, we're saying nothing's going on. We're going to hit analyze portfolio. And look at this. From 1990 to 2021, we're at 136,000. That's a DFA, Dimensional Fund Advisors. Look at that. I mean, your goose was cooked. I mean, you were down to $26,000. Do you really think you would have kept staying in this portfolio right then? I bet you wouldn't have. And look at this. You're still at 2009 at $44,000. You didn't break even until 2016. It took 26 years to break even. All right, let's start pulling some money out. And I mean, there's no way around. It's going to get freaking bugly. That's butt ugly, my friends. Butt ugly. Doing the butt. Sexy, sexy. Doing the butt. All right, so look at this. You ran out of money in 8 years or 9 years. If you're pulling 5,000 a year out. Again, this is a small cap, so it's not quite as it wasn't as bad in Nikkei, but still pretty bad. I mean, just look at the returns here. Down 33, down 26, down 54, and you're done. Now let's start adding. My wife's working down. Listen to old 80s music. Oh my goodness. Oh, 80s music was the worst. All right, so here we're adding money to it. Now look, you're just plugging money in. It's not doing anything. It's not doing anything. Not doing anything. Not doing anything. It does something, then it starts sliding down again. But then from 2009 to now, you're at $711,000. Look at that. How awesome is that? Now let's compare that to the VTI real quick. Not VTI, VTSMX. We're at 711 and DFA, and we're going to compare it to the VTSMX, the total stock. Now we're at 2.857 million. Look at the difference. That's just $100,000 adding 5,000 every single 5% each and every year. Actually, probably should make that let's just make that fixed. Let's not, because it's gonna be tough to add that kind of money when let's just make it. Is it fixed? And let's just do it fixed. Let's see what that looks like. Still at 2. I guess the same thing. 2.6. They're adding 5%. You're adjusting with inflation. Now that's a significant difference. Remember, from 1975 to 1990, this is what Japan was relative to the U.S. And everyone's like, Japan, Japan Inc. All right, so let's look at the T. Rowe Price one here, because this is the PRJPX. PRJPX. It's a little bit more. It doesn't quite have the same track record because it goes back. It doesn't quite go back as long, and it misses, I think, 1990. I think it might miss, 1990 and 1991. So it missed a couple years of down markets, and it's more large cap. So if you go to what was that? PRJPX. PRJPX. Right there. So let's see. All right, so this gets 5 stars. Expense ratio is pretty, that's not cheap, but less than 1 basis point. Let's go to profile. Profile, it's right here. It seeks long-term growth of capital through investments in common stocks and companies located or primarily operations with Japan. It may purchase stocks and companies of any size, but basically it's large cap growth, as you can see here. So that's what we're shooting for, more kind of like an S&P, the Nikkei, essentially. So we're going to go back here, and if we're adding $1,000, we're not going to add anything. We're just going to look at what this guy has done over his time without adding. So you put $100,000 in 1992. What's this puppy worth today? Well, it's worth right now to $317,000. So basically 30 years, you only tripled your money. That's not good. In fact, you can see from 1991 to right here, 2010, it took 20 years just to break even. A couple of times went above, 1999, 2007, but it took to get solid. It took until 2012 just to get back. That's without adding anything. If you're pulling money out, and we're going to adjust it for inflation. All right, let's see what this. I mean, your goose is cooked, man. You're done in 2009. Again, 20. See, this one lasted 20 years, basically, 18 years. Not good. Now, let's see if you're adding money to it. And let's see what it looks like here. So here it's worth $861,000. I mean, so if you're adding to it, see, that's what I'm saying. You're adding when it's just not doing anything. Then all of a sudden it just takes off. That's what you want. That's when you want to retire. My concern, my friends, is that this is us in the S&P 500 essentially, right? And we're saying, okay, now we're going to retire and we're going to keep it like that. I don't know if that makes sense. So basically, you did exactly what you should be doing for the last 25, 30 years. You're adding when the market's going like this, going crazy, adding. And now you get this big nut. Now you're like, well, I think the market's going to keep doing that, so I'm not going to reduce my exposure. That doesn't make any sense. Take the freaking gains and move it to a less risky portfolio, because now you're in a decumulation phase. And if we go into Japan, or even a half of Japan, you're not going to recoup from that, man. So it's the same thing. You're investing in Nikkei from 1976 to 1990. You're like, yeah, look at all this money. Now I'm pulling money out, but the market will get me back. You're pulling money out. The market will get me back. The market will get me back. You wake up 15 years, you're done. Got to be careful. Take the gains and consolidate the gains. Get less risky assets. I guess the Dow right now, the market is down. The Dow, I hate to even say that market is the Dow because it's not, but everyone knows the Dow is down about 1,000 points right now. Isn't it interesting? The 10-year Treasury has dropped to 1.49 the yield. So if people were worried inflation, why would the Treasury be dropping? All right, love your thoughts. We'll see you.